Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of Price Value Partners.
And our very special guest is Bob Coleman.
Bob Coleman, welcome to the show.
Thank you for having me.
So for people who won't necessarily know you, Bob, would you like to introduce yourself and also your company?
Yeah, my name's Bob Coleman. I own Idaho Armored Vaults, which is one of the largest private depositories in the United States. We store over $1 billion in assets, mainly in physical precious metals, but we also do collectibles and fine art, that type of thing. Also, I've been an investment advisor, been in the financial business since 1992. I run a hedge fund in precious metals as well, so that's all physical metal held outside the financial system. And then we also buy and sell precious metals with wholesalers and refiners. So we offer clients some of the best pricing in North America. And I've been doing that since 2009. So when it comes to precious metals, I've really kind of made, we also have an armored logistics division where we have armored trucks. We can actually also move metal around the world. We've taken deliveries from most major exchanges and programs around the world. So we're very apt not only at buying and selling metals, but also how to move them, store them, that type of thing.
How did you get into this business or that business?
Yeah, it's a good question. 2006, when the U.S. markets were melting up and you had 50-to-1 leverage on a lot of banks out there, I was looking at the markets because I'm more of an analyst type of thing. So I try to analyze everything. And I saw the need to hold assets outside the financial system. I saw the systemic risk building. I saw the counterparty risk building. Everyone thought I was nuts back in 2006. And I was like, this is not going to end well. And of course, 2008 happened. But getting the preparation to go into physical metals in 2006, that was a 2-year process of understanding the depository industry, the insurance industry, the logistics industry, where to buy, what to buy, how to buy. Getting all that lined up took a couple of years. And then my depository business went in operation in 2008. So it was a process that takes time, but my job is to try to analyze and watch markets and try to anticipate and try to think, okay, what's the next thing that's coming, and try to help clients prepare for that. And that's basically what I did. And of course, lo and behold, 2008 happened. And then, the metals started to go nuts. And, here we are today. We're back in the same position all over again with leverage and money printing and liquidity creation. And you have currency debasement. All those good things are back once again.
So have any of the problems that 2008 identified, have any of them been addressed as far as you're concerned?
You did have some regulation that came in, tightened down the system a little bit, reduced some of the leverage, but basically that has been like in human history, human behavior. After a little bit of time, time heals all wounds. You're back to the same thing all over again. Here in the United States, you're seeing a lot of deregulation. You're seeing a lot of leveraging up. You see a lot of this, especially in the crypto markets. You see it with laws and regulations being passed by the U.S. government to kind of expand into digital assets with very little backstop. You have a bill called the Clarity Bill, which I think is in the House right now, that will basically give Bitcoin developers and crypto developers not only any release of liability from past activities, but also going forward, any future activities with money transmitting laws and regulations. So the only other time we've ever seen the U.S. government, I think, give a sort of pass legally in a law was basically the COVID vaccination pharmaceutical situation. So, hopefully this doesn't portray something negative, but, typically when you're giving someone a free card before anything has actually happened, there's a reason they're doing that.
So for context, we were recording this on 9th of October. We've just had $4,000 in gold and $50 in silver. For people who aren't necessarily following the precious metals markets, and probably most of our listeners are, why do you think what is happening now is happening?
You've had a story the last few years where this increase in debt and so forth, the COVID, the printing of money after that happened, and this is not just a U.S. centric story. It's all over. It's Europe. It's Asia. You've had this massive liquidity creation and inflate or die policy around the world, and you've had central banks seeing all this and buying gold for the last 15 years at the same time, reducing their exposure on U.S. Treasuries, which has been traditionally pristine collateral and a safe haven for stores of value. And so as metals have started, and Bitcoin has been a proponent, I think, getting people sort of to look at the financial system from a different angle. But all this is culminating in almost a degree of trust or mistrust with governments, central banks around the world, and recognizing that the currency is the relief valve to try and get asset prices higher, which will inspire the wealth effect, which will get people to spend money. I mean, this is the world we live in today, unfortunately. And I think now the question is, the metals becoming now the second, or gold becoming the second largest currency out there, surpassing the euro. You're seeing more and more mainstream investors, money managers, and so forth recommending gold, increasing their weightings in gold, whereas a few years ago, it was very rarely talked about.
You offer a secure vaulting service. To what extent do you worry that history could repeat? I'm thinking specifically of, I think it was 1933, Executive Order 6102 under Roosevelt that made private ownership of gold illegal in the US. Or for that matter, do you think that there's a concern for that anywhere else in the world?
Yeah, there is a concern, and I've done a lot of research on confiscation, nationalization. What happened in 1933 was more of a nationalization because people actually were provided a cash return on the gold that they were turning in. But you have to remember, back then we were on a gold standard. These $20 gold pieces that they turned in, they did get $20 in cash. But being on the gold standard, the only way to increase money supply then was actually to call in gold and then revalue it higher to try and get out of that depression that we were in. So it's a much different environment than today. Today we're on a fiat-driven system around the world. There's nothing backing any currency out there. There's no need to call in gold. If there was a situation that would develop, actually the way that I see it happening would be the U.S. Treasury would call in or maybe mark up the price of gold to say, let's just say $5,000 an ounce, for example. And then in the United States, there's something called the U.S. Exchange Stabilization Fund, which that gives the U.S. government opportunity to trade in the gold markets using the Federal Reserve's New York trading desk to be the sort of the trading operation. They could actually create a bid and offer around a fixed price if they wanted to revalue gold higher. And then what would that do? It would basically allow the 8,000 tons of gold that's on the Treasury balance sheet to actually be revalued at a higher price, which would in strengthen the U.S. Treasury's balance sheet. And they would do that most likely to maintain confidence of foreign investors that own U.S. Treasuries. That would be a positive development that would actually be, I think, good for the country. But at the same time, there's a cost to pay, and that's obviously, the U.S. government would be more involved into the broader gold markets, because they can't just simply raise the price and say this is the new price. The markets would just dump, and if the U.S. government was just going to sell gold at that price, the price would come crashing right back down. But if you're doing it to actually maintain and strengthen the balance sheet position of the government, that would be a totally different case.
I mean, here in the UK, partly because we have an abominable Labour government, the sense of crisis is quite palpable. What do you think the next or the ultimate step will be? Because there's a feeling of real, like, fin de siècle, end of era type stuff happening with fiat currency. What do you think will be the next development?
My concern would be fascism, that you're starting to see develop. Imagine, you're watching, the guy that's spinning the plates, and the plates, or you watch a top that's spinning and it starts to wobble, and it starts to become more volatile as it's slowing down. that's what we're seeing with the financial markets right now. You're trying to maintain high asset prices, because if they don't maintain those high asset prices, the collateralization that's backing all this debt will just evaporate.
That sounds an awful lot like a Ponzi scheme.
Yes, yes, and unfortunately that's why gold has been becoming more mainstream, because people, I think, are waking up and saying, "Listen, I'm taking chips off the table. Gold will never go to zero. It could go down in price, but at least I have no one else's promise to pay when I hold that gold coin in my hand." That's one of the advantages of the precious metals. And that, of course, then that gets into a whole litany of other questions. It's how you hold it and store it, or invest in it. That's a whole different matter that people have to really do some research on, because most people that hold precious metals may go through an advisor or an ETF or some type of structured program, and there's a varying degree of risk that they're actually taking. So if you have a disruption in the system, so to speak, it can impact the precious metals industry as well. And if the sponsor of a program that someone's invested in isn't prepared for that properly, because most storage programs are owned by gold dealers or financial institutions, that type of thing. So they're really, the storage side is really just a small part of their business. But understanding all that, the need to own it, I think it's very, for most people, I think holding it directly is probably the best way.
So you said in 2000 and maybe 7 going into 2008, you saw that the markets were overvalued, and that's what attracted you to gold. Whilst gold is going up at the moment, do you also see potentially the risk of a crash coming? And if so, how far away do you think we might be?
Yeah, on the general markets, is that what you're referring to? Just the overall general markets?
Yeah, because you said the banks were over levered in 2007, which was clear, and it seems like not a lot has changed. And here we are with a rise in gold price. Similar scenario, except gold is tearing higher with lots of other commodities. I think around that time, oil was also going up, but that's not moving at this point. So I just wondered whether you thought, from your perspective, whether equities were overvalued and at risk of some kind of collapse. Because if you look at what's going on, Taleb, for example, has blamed Trump for the fall of the dollar and the rise of gold. And then somebody made a very pertinent comment by saying, but actually gold is going up against all currencies, so it's not just Trump, which makes sense. But we've also seen equities at all-time highs in virtually every country across the world. So how much of this is money printing, fear, and a bubble? And whilst we can allocate to gold, at the moment, you could also be allocating in stocks because they're still going up.
Right.
So how are we close to... are we closer to a reversal in stocks than we would be in precious metals, if that makes sense?
Yeah, totally. What you just explained makes a lot of sense. Being in the business since 1992, I've seen a lot of bubbles and then collapses and so forth. This reminds me of the 1999-2000 sort of internet bubble. If you go back there, you had a lot of companies that weren't making any money. It was clicks and eyeballs and a lot of credit, a lot of selling on credit and sort of channel stuffing. And you're getting the same, very similar things with AI. You're seeing a lot of round and round type transactions that are looking great from an optic standpoint on a headline, but from when you start digging down into the stuff, it's like, how do these companies actually expect to pay for these chips or processors or whatever? You have what I call an everything bubble. Everything is melting up. And this is due strictly to liquidity creation. And you're right. Everything, you look at stock markets around the world, they're all going up. And while the mainstream economies are, you're seeing rolling pockets of recession and stagnation. This is a financially engineered financial markets, global markets right now. That's what it is. And it's, whether we call it survival, economic warfare, whatever it may be, these countries cannot afford for these markets to go down. And in essence, here in the United States, for example, on top of that, the government is trying to figure out ways, how do we continually finance our deficits and get people to buy treasuries while we're actually using an inflationary type of policy of spending and deficit creation and all that kind of stuff. So you have this attempt by governments to try to keep rates as low as possible, which is, I think, stoking sort of this fear of inflation that's going to be coming. And that's why people, I think, are going into gold partly, in precious metals. With all that said, because in the United States, if you can kind of reduce artificially the interest rate, most 80% of the U.S. government debt is, I think, 1 year or less T-bills. So if you can actually manipulate the interest rates down artificially, all of a sudden you can cut your interest expense. You therefore can cut your deficits down, and things look a little bit better. They appear a little bit better. But the concern is, I think the longer end of the rate curve is actually going to go up, expecting inflation and term premium and so forth to start increasing. So it gets a little bit convoluted, but this is a financially engineered sort of melt up. And with that said, whenever living through these things, and I can just tell you, in August of '99, the melt up started in the markets, or actually had been going, but started accelerate in August of '99. Everyone thought, this is nuts. I mean, you're seeing companies doubling and tripling, in just weeks. And then by December, it was so crazy. The NASDAQ got even crazier. The NASDAQ index doubled just in the month of December. And then when you thought that was nuts, it doubled again between January and March before it topped. So these things can go on sort of longer than one can stay solvent, if you're trying to fight this. And that's why you're seeing these short squeezes, some of these stocks going up 30% one day, these large cap companies like Oracle and AMD and so forth. And that's supportive behavior. But the cure for high prices is high prices. And so at some point, it's going to cost too much to maintain all this stuff. And you're seeing margin debt explode. You're seeing margin debt relative to cash holdings and all these other types of ratios. Everything is getting to extreme. And that's the scary part, is it could get even more extreme. And so you just have to be prepared for that. I think with the metals, at some point, when you do get this big pullback in the markets, it could suck down the metals just as much as it does with the general markets, mainly because it's a liquidity-driven event floating everything up. That liquidity will create margin calls and forced liquidations, like we saw in 2008. You had, after Lehman Brothers failed, I mean, there was a point where you couldn't buy a gold Krugerrand for 2 weeks anywhere in the world, but gold still dropped 25% in value after Lehman Brothers failed, because you got into this complete liquidation event. But by the end of the year, between September and December, gold went down 25% and came right back up and was actually positive on the year. So there's going to be volatility. It's just, I think the metals will lead out of this with the expectation that any massive volatility event is going to be cover for the central banks to come in and try to create even more liquidity, as well as governments trying to financially engineer, whether it's yield curve control or just basically trying to refinance debts even shorter term timeframes.
It's
a difficult question to answer, because we're trying to, if you're trying to price anything in a fiat currency, it's like, as someone once said, trying to measure a suit using a piece of elastic. But given that problem, how high can this go in your view? Do you have any kind of price target in mind? And subject to the imperfection of pricing stuff in fiat.
Do you mean gold?
Are you talking
for gold, for silver?
Oh, okay. Yeah. Silver, being that I manage a hedge fund, for full disclosure, it's over 99% invested in physical metal. I'm very overweight silver. It's probably 73% silver at this point, 15% gold, and about 3% platinum. My expectation this year was that we would probably march towards 65, 70 on silver, as part of this melt up. Gold, I think there's typically what you see is, as the white metals pick up the pace, they tend to accelerate they may lag gold initially in the rallies, but then all of a sudden the white metals kind of come alive. They're smaller markets, and then they can go vertical. And that's what I kind of see. Kind of what my expectation was. The flip side to that, though, is it may all peter out at the same time or near the same time, where the broad markets, the stock market, and so forth, peak out at the same time. Because ultimately, what happens is, as commodities start lifting in price, inflation becomes more of a topic, and that starts putting pressure on the fixed income markets. And then, like we saw in 2006 to 8, oil went to $140 a barrel, completely, started choking off the economy, and it became absolutely evident that they couldn't just financially engineer housing prices higher and so forth. You had this reckoning, and I think oil right now, I think, is being held in check. But that's only creating potential supply destruction, because a lot of U.S. drillers and so forth can't drill at $60 oil. I mean, they need a higher price, and so these things have a way of healing themselves or fixing themselves, but it's going to create a lot of volatility. And the fear that I have going forward is that when you do get the big smash down in the markets, I think the investor is shifting their mindset to say, listen, I don't know about the currency anymore, because there's so much debt out there. There's no way they're going to pay this stuff off. And otherwise, you're going to have, the biggest fear out there with investing in government debt is insolvency. And then after that, you're going to have social chaos. And so that's why fascism, some type of form of that, is something that has to be, put into your risk model, where governments start to clamp down. And I think you're starting to see that.
Do you think the fact that oil's not going up might have something to do with the proliferation of electric cars? And if you look at uranium and presumably nuclear energy, that might be where the shift has become or will be moving towards. I know it's always difficult in the markets to know exactly why something's happening, but do you think that's a possibility? Because given there doesn't seem to be any other reason why it wouldn't be going up, especially with such geopolitical tension going on at the moment.
Yeah, there's the Ukraine thing. A lot of that stuff is high level politics. So, but there's a lot of optics involved with oil. It's a very politically motivated asset. Especially what you're seeing with Venezuela and the U.S. government getting involved over there. Venezuela is a huge reserve of oil. I think part of the issue with I think at some point with electric vehicles, you're going to need to have some battery out there that makes distance and so forth, and charging and maybe bringing down the cost of that battery more affordable and more economic and efficient than the current electric car. And it's interesting, when we're talking about silver, there was a article that I think it was Samsung that was making the silver, I think a diode battery that had silver in it, that actually increased the efficiency and length of time of charge. You could cut in half the charging time to fully charge the battery, and it would last a lot longer than the typical lithium battery. And that could be what's driving silver right now. It could be this electrification story that is behind the scenes as this battery is taking hold, that could actually give a lift to electric cars. But here in the United States, electric vehicles have been suffering. We went through a cold spell a couple of years ago, and people got to see in the Midwest, wow, the battery charge just absolutely drains when the cold weather hits it. And so it kind of created a resurgence back to internal combustion engines. But yeah, it's human behavior has an odd way of being, moving from asset to asset, or from whatever style of or trend, I guess you could say, is happening.
That's really interesting. I mean, I'd suggested, and it's like I'm a technical analyst, so I just look at the markets and see what's moving, and but I was thinking that because of AI and because of the efficiency and the arms race between the countries to get the best product out there, the fact that silver is the best conductor of electricity, it could become a super valuable asset. And if I was Elon Musk, I'd be buying a ton of it. And that might not be why it's going up. And from a technical point of view, I don't care why it goes up really. I just like to posit ideas. But it is interesting that we're seeing these things come together almost like a perfect storm with the things that the government are doing. I'm absolutely fascinated by palladium because everyone who I've spoken to or who's bullish on precious metals, nobody mentions palladium. And I love palladium. It's made a really fantastic technical breakout. It was actually outperforming all the metals like just yesterday. And I just wondered why, not that you have to be long palladium, but why is it's not in your portfolio?
Yeah, palladium is mainly used for catalytic conversion, and it's primarily has always been like more for gas engines. Platinum has been more for diesel, but platinum can also be used for gas as well. When palladium was really expensive, you started to see this switch by auto manufacturers to go into use platinum into catalytic converters. But palladium, unfortunately, when you're talking about clean energy, palladium story kind of stops with internal combustion engines, whereas platinum story extends into hydrogen fuel cells. Platinum is the metal of choice when it comes to the catalytic reaction that powers the hydrogen process for automobiles and so forth. And with that said, that extends the usage of platinum more so than palladium. So that's why I went, and platinum has an interesting storyline because from the research I've been reading, it's basically looking to be, the above ground stock is looking to be worked off by 2027 to 2028 because of the supply constraints and mining constraints of pulling platinum out of the ground. It's very expensive to pull it out of the ground. Platinum has been in a vicious bear market since it peaked in basically was it 2008 or so. It ran back up and then it crashed back down again. And it's just been 15 years of going nowhere basically. And so it's had a massive effect on the mining production and so forth. So to get these platinum mines back on track, you have to go down really deep. You have power issues in South Africa. Platinum mainly comes out of South Africa and Russia. And so a lot of the platinum that's, for example, and palladium that's made in Russia flows to China, and there's not much left over coming out of South Africa for the rest of the world. So you've been working off of these above ground stocks. And that storyline, when you start to throw hydrogen fuel cells into this thing, creating a new demand for platinum could overrun that market. And that, to me, that makes a little bit more sense rather than palladium, which is mainly more for that traditional internal combustion engine.
But that's a problem really for the whole commodities sector as a whole, isn't it? That there's just been insufficient spend on infrastructure for decades.
Yeah, the digital world has made us, I think, is creating this false sense of security, unfortunately. And this is all part of watching markets for as long as I have, for over 30 years. You watch the psyche, you watch the mania, you watch the madness of crowds, whatever you want to say, and it becomes, when that asset becomes a religion, it's time to walk away. And unfortunately, I think the U.S. government has really went all in on digital, and that's been very supportive of the technology markets and Bitcoin and crypto. But the question is, one is, do we have enough energy out there to run all these data centers and so forth? But two, if you get a drop in the markets, and that guy who bought Bitcoin because all these treasury companies were basically converting their treasury cash position into Bitcoin and trying to all make the same play. If the price goes down, do they now have the same expectation versus when it was going up? You're buying, in a way, sometimes you buy these assets on what they call greater fool theory, where you're just hoping to sell it to somebody else at a higher price.
Yeah, and it's also the cost of energy. See, at the moment, I think Bitcoin's being supported by the fact that oil isn't that high, and you're converting energy into money if you're a miner. And I noticed that as oil goes up, it does seem to have some negative effect on it because, of course, if energy prices go higher, you don't make as much profit from it. But there's also then the speculative market that's become even greater. So would it be fair to say that you're not particularly enamored with cryptocurrencies, or do you see it potentially as a not fiat asset and therefore it has its place?
Yeah, I'm being an investment advisor and portfolio manager and managing assets for a long time. I kind of look at myself as if I was put on the stand in front of a jury and recommending an asset and say, well, prove or explain why you recommended this asset if it collapsed, for example. Why did you recommend it? And with crypto, it's very difficult to play the long game when knowing
there is
that
no
you
long
can't.
game. There has been no long game.
Right. Yeah, it hasn't had 5,000 years of history. It hasn't had it only was really the birth of it really came after the financial crash. Every big drop in the markets has seen a massive decline in a lot of times in Bitcoin and the crypto market in general. It's levered to the hilt. There's very little regulation, and it's somewhat times the Wild West. There's a lot of scams involved and so forth. And there's a lot of leverage. I mean, you look at MicroStrategy's strategy, which is basically it's all in on Bitcoin. And what happens if they become a forced seller? I mean, when you start throwing leverage into an asset class, it loses its sort of original store of value or transaction white paper, whatever you want to call it, and it turns into a speculative frenzy at that point. And that's what concerns me with crypto. And they may have some great uses to it, but do you need Bitcoin to be at $120,000 a coin to send some of that from one guy to another around the world? I don't know. I mean, it could be at $10,000 a coin and do the same thing. But gold, the advantage with gold is it has been tested through time. It has outlasted every empire and civilization through time. So, and it'll be around a lot longer after we're gone. So, from that standpoint, it has done a better job. It's, I look at it as like the tortoise and the hare fable. The tortoise will, ends up winning the race, but it's sometimes it's slow to get there. And I think the gold market has sort of been finally picked up and legitimized, I think, by Wall Street. I think after they basically milked and created a lot of structure in the crypto market, I think they're just doing the same thing now in the precious metals markets, creating structured products and so forth, and that's gaining interest into the marketplace. But you also have to look at the options market. The options markets around the world has created a massive frenzy where the tail, the options market, is wagging the dog, which is the equity markets, which are a lot bigger. And that's having an impact in the silver. As we see silver going to $50 an ounce, and I've been calling this all year as I watch a lot of different indicators, you've been seeing stress in, for example, the SLV ETF with the ability to borrow shares to go short. That cost of borrowing has been rising. And you've been seeing this squeeze, basically a gamma squeeze develop, and especially over the last couple of weeks with SLV. So the SLV, the options premium, volatility premium, has been rising very steadily as the price of silver has been going up, adding stress to dealers that are potentially short calls because when the public comes in and buys calls, the dealers tend to short those calls to the public or sell to the public, and then what the dealers do is they hedge with whatever the underlying position of that option is. So in this case, it would be SLV. Well, they don't necessarily hedge dollar for dollar. They only add to hedges if the price continues to rise because the calls become more in the money and their short call becomes a negative bet, more negative. So they have to actually add more exposure or more hedging, which forces the price to go up even more. And you saw this with GameStop, a very similar situation. And so that's what's occurring right now in the silver market.
What would have to change politically or economically for precious metals to lose their luster as assets?
Yeah, it's a great question. I mean, if the government decided, or they woke up one day and the economy is doing great,
Let's balance the budget.
balance the budget. We start to curtail all this excess spending. Do a lot of cutting in terms of austerity and so forth. But
no
I don't know
corruption.
how.
Fat chance of any
Yes.
of this happening.
Yes, yeah. You'd have to have complete trust, coming back into the markets, coming back into politics. You'd have to have, this removal of friction between countries, trade barriers, and all that kind of stuff. It would take time for that to happen, and I think it can happen, but these cycles have to play out, unfortunately. And gold is one of those assets that it connects you from point A to point B, that chaotic time until you get past the rough patches. And then, that rough patch creates, the opportunity again where pricing dislocations are now reset. You have a reduction of malfeasance that all this money printing has created. Those things have to happen for, I think, the metals markets, where people start to say, okay, I can now see things normalizing again, and maybe I don't need precious metals. But like we've seen in the past, gold, you look at the gold to Dow ratio, for example, it went 1-to-1 in the last 100 years. I've not to say gold's going to go to 30 some odd $1,000 an ounce, or the Dow is going to crash. But you can see an intersection between that and the S&P 500. Where the S&P 500 comes down, gold goes up, and all of a sudden gold on a relative value basis may be more expensive than the stock market. And then at that point, it may be worthwhile to start edging or scaling out of your gold position and going back into the stock market. So there's ways that the markets reset themselves.
I'm just mindful that you said you had half an hour and we've gone slightly over. So do you need to go, or can we get some final questions in?
Yeah, we get fine. Yeah, definitely.
Tim, did you have some final questions?
No, I'm overdue, Paul. I don't want to be accused of hogging the mic.
Okay, neither do I either. So first of all, you said right at the top of the show that you're looking to be outside the financial system. That's extremely difficult to do, as you were alluding to. And if somebody listening to the show was thinking of trying to set their own personal finances outside of the financial system, what would you suggest would be a good avenue to explore?
Yeah, it's a great question. I kind of call it as governments aren't going to go on a gold standard. So you got to put yourself on a gold standard, if that makes sense. And holding financial assets, to me, gold and silver are, I think, one of the few financial assets that have a lot of history to it, that you can actually hold personally, for example. Maybe in the UK, it's a little bit different because you have the value-added tax on silver, which makes it more expensive to get into. But there's ways we have UK clients that store over here in the United States that own physical silver. They don't have to worry about the value-added tax. It's held over here in their name on a segregated basis. So there's ways to help people structure and hold and maintain control over their own assets, where the asset isn't commingled with anybody else. It's not part of a pooled program. It's fully segregated. And so it's important for people to understand that there are ways to expand their portfolio. The advantage especially with UK citizens, they have a huge advantage than the United States, where they can buy gold and silver Britannias, and those are capital gains tax free. I mean, there's an incentive there actually for the citizens to actually own some of those metals. Well, from a tax basis standpoint, and then so there's some interesting narratives that when you start digging into the world of precious metals, there may be some other benefits that you may not have been aware of, for your listeners. So those are things that I think just start the learning process of understanding holding assets out of the system. I would very much like to tell your audience, please read the agreements and the contracts. If you're going with a structured program or a gold dealer that's selling metals and storing the product for you, or you're going into securities that are represented by commodities like the ETFs or ETPs, it's the inability to get access to that physical metal is is critical to understanding complex risks such as systemic and counterparty risk. In Europe, they have what they call UCITS, which basically push institutions and funds into these derivative products. The thinking back in the 90s was derivatives is going to be a lot more liquid than the actual commodity itself. Well, it turns out it benefits the banks and the market makers. It doesn't, So of course they're gonna create that regulation for the benefit of the ones that are kind of regulating them. There's a lot of stuff to read and understand, but these are just a few of the elements when you're trying to put yourself on a gold standard.
When it comes to investing and trading, will you look at any asset that's out there, any sector that you think might catch your eye, or do you have a certain structure within the fund that says that you invest mainly in precious metals?
Yeah, no, the fund has very wide discretion, so I can go into anything pretty much. But my focus, and I do a newsletter every month for my hedge fund clients, so I'm very communicative, very transparent with what I see in the marketplace. If I'm going to make a change, for example, in February, I started to alert my hedge fund clients that the fund was going to start taking a position in platinum. So in March, I started buying platinum in the 900s, low and mid 900s, and was basically fully invested in it by April, or very early April, and then it just took off. But I'll create the case, put that down on paper, and provide that type of transparency to the client base, so they kind of get an idea. Now, if gold goes to some exorbitant number and it's vastly overvalued and it's beyond stretched in terms of valuation and it's above an upper Bollinger Band line, by a 2 or 3 standard deviation, and you're never going to get a rip-roaring pullback or something like that. Yes, there may be times to trim, try to manage money, take profits, protect the gains, that type of stuff. That's certainly definitely feasible for the investor community out there. But I try to look at the theme of a little bit longer term investing rather than trading, so to speak. I used to do day trading and that type of stuff back in the 90s and early 2000s. But in this market environment compared to that market environment, you're really you can't compete with the algorithms and the computerized trading, and especially the AI models out there. The market's just moved too fast to think that you're going to stay ahead of the game that way. So sometimes simple is better. You try to understand. And this year, the precious metals, have had a massive outperformance over the general markets, which isn't really talked about too much.
Should we expect? I'll get one final question. And should we expect to see some potentially big bankruptcies by perhaps the hedge fund community, because not every fund can be long these precious metals. Some of them must surely be short.
Yeah, you see that with the managed money crowd in the CTAs, the commodity trading advisors. They'll be short or long positions. They'll be they may have hedges on, that type of thing. You have to worry about the industry, the precious metals industry. You have to remember, even within the industry itself, there's risk. There's fabricators that, for example, have underlying inventory that is hedged with futures contracts. And if you had, for example, earlier this year, where the EFP, the exchange for physical spread, which is the difference between the spot price in London and the New York futures markets, when the New York futures markets took off relative to the spot price, a lot of people that were hedged lost a lot of money because the futures price, which they're short, accelerated higher faster than the cash position or their actual physical inventory. Right now, what's happening is the exact opposite. I mean, we just hit I've never seen this before, where we're backwardation right now, where the futures price, the December contract at one point today was $2.50 cheaper than the spot price of the metal. I mean, the futures market is going down, and the cash market is going up. And that dislocation is creating a lot of potential players that may be short the actual spot price, and that they were maybe long the futures price because maybe they were trying to say, listen, I got the margin, I got leverage in the futures markets that I can't get with the cash price. And so they may have done the opposite trade where they may have been long the futures and short the cash, from a hedging standpoint. Well, that just blew up in their face. And so you have this dynamic that's going on, and you have tightness in London currently with lease rates going up and so forth, and the ETF flows and the demand for silver to get that metal into the ETFs. That's all creating this immediacy for spot metal, and that's creating this sort of loop effect that's been pushing prices higher. And so from that perspective, those risks start to open up where you least see them, and that's why it's not just simply hedge funds that could be at risk. It could be other participants out there.
Bob, I know you've got to get back to your screens, and just want to say thank you so much for coming on the podcast. Just before you go, let everybody know where they can find you if you're on X or your website, etc.
Yeah, definitely. Our website is goldsilvervault.com. We have a blog page with interviews and articles that I put out and so forth. You can find me on X at Profits Plus ID. That's PROFITS PLUS ID as in Idaho. And I put a lot of information on a daily basis that talks about market structure. I stay away from the conspiracy side and the manipulation story, but I try to give people a good education of what's happening in the market, maybe what to expect going forward, and where the pressure points are and so forth. So I think it helps people with the story of investing in the precious metals to understand, okay, it's not just simply the banks controlling the markets. There's actually a market structure, and there's some reasoning that happens, or why things happen for a reason, I should say, and that has effects on the price.
Brilliant stuff. We'll put those handles in the show notes as always. Thanks once again, Bob, and hope to have you back.
Sure, my pleasure. Thank you for having me.
Thanks, Bob. Appreciate it.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.